$65 billion in unfunded liability by 2018 is a number that's been put out there. Obviously, a much bigger number than what we're looking at now, and we all knew it was going to grow. It wasn't done rising.
Yeah.
Can you talk a little bit about some of the proposals that were out last year that may or may not be part of the discussion now? I know you have a proposal that you introduced back in September,
right,
and a couple other representatives have plans of their own. Can you talk about yours, and then a little bit more about the other plans
Sure.
on the table?
Sure. The one that I did mention earlier has to do with just putting future employees into a defined contribution plan, switching that risk paradigm. If you do that, I don't think you've addressed the totality of the problem,
Mm-hmm.
and you might reduce some costs going forward, but you still have that unfunded liability, whether it's 45 or 55 or 65. And you're correct, it is going to grow because of this ongoing underfunding of the plan. There's a real liquidity problem at both of the plans where, and I don't want to get too technical, but the amount that's coming into the plans each year from the employers and the employees isn't sufficient to pay the current year's benefits
Mm-hmm.
for people who are already retired. So the funds have to liquidate some of their assets each year in order to pay current member benefits.
Sure.
And you can just foreshadow that you can't go on doing that for a long period of time. So liquidity, in my view, has to be addressed as part of any solution.
Mm-hmm.
So the way I've looked at it, and my proposal, I break it up into three pieces, or I call it three buckets, because I'm trying to get savings toward that unfunded liability from each one of the three buckets. The first one has to do with future members. And everybody believes that, well, not everybody, but most people who are looking at this issue believe that the current defined benefit paradigm is just not sustainable in the public sector.
Yeah.
So we need to move to something either like or more like what the private sector does.
It's the main push, yeah. It's been the main argument the last few years.
Right, the 401k is sort of the ultimate, because all of your investment risk gets shifted to the employee. My proposal isn't quite that harsh. It goes to what we call a cash balance plan, which is a hybrid plan. It's part like a defined contribution, part like a defined benefit plan. And by that I mean, under a cash balance plan, the employee puts in money, in my plan 7%, the employer puts in money, in my plan 4% match, but when the employee reaches 15 years in the system, there's a bonus for longevity, so the employer contribution goes up from 4% to 5%. So that 11 or 12% is invested by the retirement systems. It's not an individually invested account.
Okay.
Because the employee is not investing their own money and the fund is investing that money, we believe that there's an obligation to guarantee at least some rate of return on that money. So my cash balance proposal is that the employee is guaranteed a 4% rate of return on that money. If the actual returns are more than 4%, there's a sharing formula so that the employee will get some of that increased earnings and the system will keep some of that to guard against those years where the return might not be 4%. So that's how a cash balance plan works as you're building money. It's sort of like a defined contribution plan, but when you retire, whatever your benefit is at that time is frozen and put into an annuity, so that from the time you retire, you're guaranteed a monthly check in a certain amount for as long as you live.
Yeah.
So you don't have the risk of outliving your retirement earnings. And you're not walking out of the door of your employer with a check and a pat on the back saying, good luck.
It gives you more stability.
Right, it gives you the
future
flexibility, the certainty that you want in a defined benefit plan. So that's bucket number one. The projections are that we can save somewhere between $7 and $8, maybe $9 billion over that 30-year window by moving future employees into a cash balance plan. So that's bucket number one. Bucket number two, I feel it's really important that the Commonwealth make up for those years that I talked about earlier where we were not properly funding the plan.
Yeah.
The employees have a very legitimate argument that we would not be in nearly this bad a situation. We'd still be in a problem. We wouldn't be in nearly as bad a situation if the Commonwealth had simply made the payments. So I'm proposing that the general fund make up for that by borrowing up to $9 billion. Now keep in mind, we already owe $45 or $50 billion, so it's not new debt. It's just taking a piece of that debt that we already owe, issuing bonds so that the payments on that, future legislatures, future governors can't tinker with that. Once it's issued on a 30-year bond, you have to make the quarterly bond payments.
Yeah, and you can get at a lower rate now.
Right. The borrowing market is attractive now to do something like that. But I see it really as making good on the past promises of the general fund that haven't been satisfied. If you put $9 billion into these funds up front through this borrowing, it has the effect of reducing that unfunded liability by $15 billion because you're front loading it.
Yeah.
So that's bucket number 2, a tactical borrowing to make up for the past underfunding.
Mm-hmm.
Once you've done that, then I think you can legitimately go to the current employees and say, look, we need your help in solving this problem. We're not going to force changes on you, but there are 2 changes that we would like current employees to consider. And constitutionally, we have to give them something in exchange for that. So my proposal says to current employees, if you will modify 2 things, which I'll give you in a second, we will reduce your employee contribution by 0.5% for the rest of your career. So we're giving them something. We don't have a constitutional issue where we're forcing these changes on them. The 2 things we're asking them to change under the current proposal, and this one's a little technical. It has to do with the lump sum withdrawal that you can take at the end of your career, where you can pull out all the money you put in and you still get a monthly benefit because the employer money is still there and the investment earnings are still there. But your monthly benefit is not reduced as much as it should be to be actuarially sound. If you leave your money in, we're assuming at the fund that we're going to earn 7.5% return on your money.
Yeah.
If you take it out, we only penalize you by 4%. So the change we're asking, you can still take your money out, but if you're going to take your money out, current employees, we're going to reduce your monthly payment by the 7.5% that it really should be to make it actuarially neutral. So change number 1, actuarially neutral lump sum option 4. Okay. That saves $13 billion over 30 years.
It's because a lot of people are
right. Everybody
out,
pulls their money out. Why wouldn't you?
Yeah.
So that saves $13 billion. Then the second change, when you under the current system, your monthly benefit is the formula is based on a 3-year final highest salary. So they take the average of your 3 highest years, multiply that by the multiplier, and that determines what your benefit is.
And that's usually at the end of your career.
It's usually,
career.
not always. It's the 3 highest years, which oftentimes are the end of your career, but not necessarily. We're asking that it go to a 5-year final average salary. For somebody who's on a steady increase in their earnings, it's not going to have that big of an effect. But if anybody is spiking their income in those last 3 years, either through overtime or special assignments or some sort of promotion that's given to them in their last 3 years of service, it has the effect of really spiking that monthly benefit for the rest of their life. So this the 5-year final average salary would have the effect of tamping down pension spiking. And the savings from that is about $6 billion. So the total of those 2 changes, $19 billion toward that unfunded liability. Now, remember I said we're going to give them a 0.5% reduction in their employee contribution. Yeah. So that comes off of that, but it's still a net of about $15 billion worth of savings. So bucket 1, we've saved, let's say, $7 billion. Bucket 2, we've saved $15 billion. Bucket 3, we've saved $15 billion. The combination there, we've addressed 37 out of the $45 billion unfunded liability. I think the bond markets would look very favorably at that kind of a comprehensive approach. There's pain. There's school districts going to have pain. The general fund's going to have some pain paying the bond payments. Current employees are going to have a little bit of pain, but it's spread out, and it once and for all addresses sort of the totality of the problem.
But it's hard to get people to buy into that because everybody thinks short term. I mean, so out of those 3, it's really what's more likely that we could see. I mean, all of it together, it's hard for people the majority to buy into something like that. What are you more likely to see in some type of compromise given the recent history of reforms that were made in 2010?
Well, I mean, given the recent history. The 2010 reforms came about because the governor wanted to impose collars or rate collars on the amount that the employer contribution could go up. That was to provide short-term relief to the general fund and to school district budgets. Well, I took the position at least, that we can't just do rate collars and reduce the employer contribution, because that's what got us into this problem in the first place, underfunding the plan each year. So we said, and we negotiated, okay, if you're going to reduce the funding through these rate collars, you have to pay for that, more than pay for that, by long-term reforms. And that's how we came up with the reduced multiplier, the lengthened vesting period, and the other changes that I talked about that are in Act 120. So I sort of see, if there is a middle ground, that's sort of where the middle ground is, that we have to find a way to make savings toward the unfunded liability at least in an amount more than the short-term relief that people that are making budgets are trying to secure at least in this next budget cycle.
Yeah, I guess we'll have to see. I mean, the collar tapering kind of gets most of the attention. Everybody wants that, short-term relief. Let's not have the percentages go up quite as much as they were originally intended to. So
yeah, everybody wants the benefit, but not the pain that goes along with it.
Yeah,
It's troublesome.